Hello, fellow value investors. Welcome to another episode of Buffett's Blunders. The guy is maybe one of the best who ever did it, but he still made mistakes. Everyone does, known as a 100% success rate, and it's worth looking at the mistakes that he did make. He learned from them, and we might as well learn from them too, instead of needing to learn the lessons the hard way. So, this week we're going over Hochschild-Kohn Co, which was a fashion company, a department retail store company that he purchased, and it really changed his investment philosophy. In my opinion, I think it's kind of a key point of him going from cigar butt investing and beginning to be convinced towards Charlie Munger's view of buying great companies at fair prices instead of trying to find fair companies at great prices. Hochschild-Kohn Co. is almost the definition of a fair company at a great price, and this cigar butt burned him. So let's get into it. So here's a brief history of Hochschild-Kohn. In 1897, it was founded. It was a local homegrown retail store. It ended up becoming Baltimore's largest department store, and those tend to attract Buffett. In the future, they did these like single locations that are like the heart of a city. It was on the same corner for 7 decades. 3 generations of the families ran the store. They ended up integrating a restaurant into the building, which was a first. And here is why it looked like a bargain to Warren Buffett, because back then he was in more of this Ben Graham cigar butt net investing, right? So it was below book value. It was priced under its net asset value. So from his point of view, he's getting more than $1 per dollar. If he can just unlock the book value, if he can even get middling return on equity on the equity, it's kind of leveraged by the fact that, say, he's getting $1.50 per dollar. I can't give you the exact numbers, but if he's getting $1.50 per dollar and it's, say, an 8% return on equity, that's a 12% return on his equity. If he can get 10%, that's really 15% on his equity, right? First class people, this is something you'll find with him always. He always loves getting into business with people he considers to be good business people. Charlie Munger talks about always inverting. He talks about what would you do if you wanted to lose money, and in that case, you would get into business with bad people, with crooks, with lazy people, people with no vision, people just there for a paycheck. So they invert and do the opposite, and they go for businesses with first-class people. 3, there was hidden real estate on the book. So on top of it trading below book value, there was a lot of hidden value in the book. So when they bought the real estate, the way the accounting was done, to my understanding, is that it was held at the cost. At the cost they paid for these buildings some 60, 70 years ago even. That's what it was held at on their book, even though there's 60 years of the building appreciating. It didn't appreciate, of the land appreciating. And then on top of that, the building actually depreciated. So 60 years of depreciation says the building's worth nothing on the book, but in reality, the building is probably worth more, even though in the accounting it's been depreciating. And then also they had a last in first out inventory system, which means that if they sold a piece of menswear or something, they would say that they bought that at the price of like the most recent menswear shipment they got. And over time that starts to build up. Unless you sell out all your menswear, let's say, then you always have some unsold menswear, and that's always going to be held at the oldest cost. So they had inventory that was being held at cost of what they paid maybe 50 years ago to get some menswear in the store, to get some hats in the store, to get some shoes in the store, whatever, because they never sold every shoe. So the shoes that were unsold, some of them were at those very old prices when in reality they were new shoes, not 50-year-old shoes that were worth much more. So not only was it trading below book value, he thought the book value was an understatement. He said, we thought we were buying a second-class department store at a third-class price. So that is the definition of a fair business at a great price instead of a great business at a fair price. I'll also say on top of it, I think he learned some hard lessons about retail, department stores, and fashion beyond buying mediocre, fair businesses. He also learned this is a much more cutthroat business than he had thought. He thought that that speaking last time about like the character of the industry overrides the character of management, he may have misread the character of the industry of retail department stores. He might not have fully understood it. This is his first time getting into one as a control situation where he's going to be controlling the company. On top of that, some of this net investing, as we'll find out, it doesn't work as great when you're the one pulling the levers and making the calls instead of buying 2% of some company and letting other people do that. It's a lot less comfortable when you're the one who has to go and unlock all this value that you saw on a piece of paper. So they say price is what you pay and value is what you get. We talked about why Buffett thought he saw value in this company and the value of what he got, what the company was, and all this book value. But what did they pay? So overall, the purchase price was $12 million. This was not all paid for by Buffett. It was $6 million from Diversified Retail and $6 million from a bank. This was his first time leveraging to buy a company. Before this, he would use leverage for arbitrage because he considered it kind of a sure thing with very set, like, we'll get paid this much on this date, and if they can leverage themselves up and double down on those bets, it would double their returns. He didn't think there was a high risk of loss. But here, he's leveraging up to buy a company and try to unlock value and try and run the company and steer the ship, and that's much more risky, right? So this was the formation of diversified retail companies, and maybe in a sense this was worth the loss because this was his first time working with Charlie Munger and going into business with him. Buffett and BPL, the Buffett Partnership, paid 80% of the $6 million. Munger paid 10%, and Gottesman paid 10%, and that was the split on diversified retail ownership. Buffett Partnership owned 80% of diversified retail. Munger owned 10%. Gottesman owned 10%. So the Buffett Partnership's actual stake in this deal was $4.8 million, and that's the figure we're going to be using when calculating the losses and the opportunity cost. Locals thought he was overpaying. Right? He wasn't from Baltimore, but when he went to the Baltimore bankers and looked to take out a $6 million loan with Charlie Munger, he later said this in a Berkshire Hathaway meeting. The banker kind of laughed at them. It was like $6 million for little old Hochschild-Kohn. And Buffett said that was their first inkling that maybe this deal wasn't as amazing as they had thought it was. And then he joked that almost from that day on, they were trying to get rid of the thing. So on to the timeline. Now, I had a harder time finding the direct sources for this during the partnership years and those early years. They kept their investments a lot more close to their chest. They tried not to talk about what they were holding. Buffett kind of joked that all his shareholders were surprised when he dissolved the partnership to find they owned a textile manufacturer and a stamp company and this retail store chain or whatever. The people investing with him did not know what they owned, whereas nowadays with Berkshire, you do know. It's a publicly traded company. It's much more open. He can't be keeping secrets. So it was harder to get his kind of notes along the way. So a lot of this comes from the snowball. And then after the partnership dissolved, Diversified Retail released some of its own letters. They're very short, but they do have a bit of information. So in 1966, Diversified Retail Companies formed with Buffett, Munger, and Gottesman. They'd kind of always been looking to get into business together, and they decided that this was good enough for them. Buffett was having a harder time finding things to invest in, and in hindsight, feels like he lowered his standards a bit just because he wanted to do something with Munger because there was no other good deals around. They convinced themselves that there was so much margin of safety that the leverage was worth it. They thought debt was cheap at the time relatively, so taking a loan was a good idea. In mid-1966, they completed the purchase. So in 1966-67, Buffett killed the plans for a Maryland store, and he did approve plans for a York store. I'm gonna pull up a quote for this. Okay, so I'm not going to show the book on screen just to avoid any copyright issues. I'm going to stick to reading quotes for the most part. So this is a quote from Buffett. They'd been planning those 2 stores for a couple of years. The guy that had the men's furnishing department had his section laid out. He knew exactly how he was going to decorate it. The woman who ran the high-priced dress department had hers all planned too. He didn't like confrontation, and he ended up shooting it down. Him and Munger, they both agreed that both stores were a bad idea, and they ended up taking the Maryland store out back and shooting it, but they tapped out on the York store. And he said that he killed the Maryland store and everyone in the room died. They just died, he said. So they were not happy. It kind of killed the morale at the company, but it was also bad. And they went for a half measure, if you want to use a Breaking Bad reference, when they should have gone for a full one way or the other. If they could have made the bad investment and made everyone happy, or they could have killed them both and protected their investment. But they took a half measure. They made everyone unhappy and made a bad investment. And it went very poorly. So then in 1967, they acquired Associated Cotton Shops. This ended up being a much better investment. This one turned out great. Buffett talks about how they get like a 20% return on equity with this, which is like one of the best companies in the market if it was publicly traded. In September of 1968, the York, Pennsylvania store opens, and then in 1969, they managed to sell Hochschild-Kohn to Supermarkets General. I'm going to pull up some quotes for 68 and 69. There's also a quote from Munger saying that Hochschild-Kohn was like buying a yacht, where the only 2 happy days are the day you buy it and the day you sell it, and it's just a giant pain in the ass in the middle. So let's go look at some of the diversified retail letters. Okay, so this is the 1969 letter about 1968 from Diversified Retail, short and sweet, but it says these earnings of about $2 million in fiscal 1969 were substantial, but were $400,000 lower than the previous year. This reflects a few reasons, and the third of these reasons is a lower profit margin at Hochschild-Kohn, reflecting the cost squeeze which many department stores were unable to overcome last year. He does also say that partially offsetting these negative factors was the superb performance of Associated Cotton Shops. So they kind of had one good business and one bad business. Let's go look at the next year. So this is the Diversified Retail letter on the sale itself. As at December 1st, 1969, the company sold to Supermarkets General Corporation 40,000 shares of common stock of Hochschild-Kohn Co. Incorporated, the wholly owned subsidiary of the company. The sale. Said shares of common stock comprised all issued and outstanding shares of any class or description of Hochschild-Kohn Co. There's then some description of how a lot of this went to just pay back the debt that they had used to buy the business. As of December 1st, 1969, and prior to the closing of the sale, Hochschild-Kohn Co. redeemed from the company an aggregate price of $4.5 million. 20,000 shares of its convertible preferred stock, Class A. The proceeds from said redemption, this aggregate amount of $4.5 million, were transferred and contributed by the company and paid in the capital of Associated. They then mention later here that as at January 28th, 1970, Reinsurance Corporation of Nebraska, Reinsurance, a Nebraska corporation, was organized for the purpose of transacting the business of insurance, with the exception of life and title insurance. So it seems similar to Berkshire. They're using this money from the failed business, and they are starting up an insurance company, which seems to be just what he does when he has some spare money lying around. He just starts insurance companies. So that's the plan. They've sold this off. They've actually sold it at a loss. They bought in for $4.8 million all those years ago, like 3 or 4 years ago, and now they're selling it for $4.5 and using that cash to start an insurance company. So I just wanted to mention here in post while I'm editing that because they used leverage for the deal, this 8% loss gets amplified to a 16% loss, right? Instead of them losing $1 million on a $12 million investment, they did a $6 million investment, leverage 2x, and they lost $1 million. The bank is still going to get all its money back. The bank isn't going to lose 8% on this. So the bank gets all its money back and they lose 16% on this. So in his own words from the 1966 mid-year letter, and this is about all he had to say about it in those letters, Hochschild-Kohn stacks up fine in all respects. That's what he had to say about the business when he bought it. In his mind, it was below book value. The people were first class. There was this real estate hidden in the book, and then there was this last in, first out cushion hidden in the book. And it was like a Ben Graham classic. And him and Munger, they studied under Graham, and they wanted in on that. The slide here, it's about the two new locations, the one in York and the one in Maryland. So and we already talked about this, so we're just going to glaze through it a bit. But, their management and planning two new stores before they bought it, one in York, Pennsylvania, and one in Columbia, Maryland. People were running from downtown into malls, so they were planning to build a couple stores in malls. As I said before, the department heads had already laid out their departments. They'd fallen in love with it. Buffett and Munger privately knew that neither of these made any sense, that new locations was not the solution. They needed to tighten the ship in the current locations and get them profitable. Buffett and Munger both knew this wasn't right. It would have perhaps made more sense to actually downsize. Maybe they should have sold off some of the oldest locations, maybe even the main location, reduce the CapEx spending, realize some of this off-the-book real estate value, lease the buildings or sell the buildings that on their book were depreciated to zero, but they could have actually realized value from. But instead of doing that, they expanded. They bought something for its assets and then poured cash into it instead of extracting cash from it. And this is because when they were actually in charge, and this is one of the first times they were in charge for one of these, maybe the second or third time they were in charge for one of these net almost liquidation like situations. In one of them, it was just about liquidating a stock portfolio, not actually firing people and shrinking. One of them was, but and they can bring themselves to do it. They can bring themselves not only to tell these people, no, you're not getting a new location, but also to tell them maybe some of the current locations have to go. Maybe the main, the main landmark location should go. That's perhaps what they should have done. During the sale, they put the money from the sale into an insurance company. Maybe they could have sold off some of the less profitable, more expensive, more CapEx heavy locations that had more of this hidden real estate value. They could have liquidated those and started an insurance company. And maybe this could have turned into Berkshire, the same way Berkshire did, where they closed down all the mills, ran the ones that were somewhat profitable until they were no longer profitable, and just extracted value. Instead, they put capital into this. They expended capital on new stores. So here's 4 mistakes from this whole saga here. The first one, that cheap isn't always good. Just because on paper it's a bargain doesn't mean that's going to work out every time. They gave themselves margin of safety, but that margin of safety didn't account for some of the real issues. And I'll actually read you a little bit from the snowball about the real issues that caused the margin squeeze. Within the first couple of years at Hochschild-Kohn, Buffett had figured out that the essential skill in retailing was merchandising, not finance. He and his partners also had learned enough about retailing to understand that it was a lot like the restaurant business, a wearying marathon in which every mile, fresh, aggressive competition would leap in and race ahead of you. So the next avoidable mistake was caving in on the York store. If they had just retained the earnings, maybe passed them up to Diversified Retail, they could have used some of that money and gotten this insurance business going, acquired something new, got something profitable going instead of doubling down on an unprofitable business. A mistake Buffett will make again, and I'm sure will come up in the series again. There was this CapEx treadmill, like it said, that there's always this fresh competition kind of coming for your throat. They had to be always, adding elevators, upgrading window displays, because the competition did. If the competition upgraded their window display and they didn't, their store would look old and people wouldn't come there. If the competition had elevators and they didn't, the foot traffic left. So they were kind of forced into this CapEx that they did not want to do, on top of the building a whole store, upgrading the old store, because they just had to always keep up. There was also mention in the book, I think it was Hochschild, I'm not 100%, where just the fashion trends changed, and suddenly the things that they had filled their whole inventory with were no longer fashionable, and they had to basically replace their whole inventory, right? Just stuff like that happens in retailing that was unexpected to them. They were finance guys, and they thought this would all work on paper, but they did not have the experience in running a retail store, and they weren't very good at it, and it was a much more cutthroat business than they had anticipated when they planned this all out. And then finally, just the wrong framework. After this, he updated his framework. He got burned by the cigar butt, and he's shied away from cigar butts in the future, and especially in control situations where they're the ones making the calls. The cigar butts, you can't leave easily. Like they said, they were looking to sell it the whole time. If they had owned some 5% of a common stock, they could just sell it the moment they wanted to, right? But they were almost trapped in this, and they were just delighted to even get out at something approaching break even, right? And then on top of that, the cigar butt framework with the real business with the real people. This is something Buffett ran into a lot later on, where he didn't want to be seen as a liquidator. But what needed to be done to get the value he had found on paper was liquidation. He kept a lot of factories and stuff open a lot longer than made sense. Just because he didn't want to lay people off. He didn't want to be seen as like coming into a town and shutting down the factory at the heart of the town and then using it to buy stock or start an insurance business or whatever, right? Even if that's what he should have maybe done. He didn't want to be seen it hurt his reputation, and his reputation did end up being valuable, something I'm sure we'll also see in a later episode in this series. So while editing, I came up with a fifth avoidable mistake that I want to add in here, and that is that circle of competence errors get magnified in these control situations. They probably did know enough about retailing to invest in retail chains, right? They probably did know enough to buy some minority stake in Nike or something like that. Just one that comes to mind that's relevant recently. But when you actually are taking control and making the business decisions and deciding how to allocate capital, it very much amplifies any knowledge gaps. And the fact that they're talking about learning how the retail business really works, that's not something you should be doing after buying a chain department store, right? You should not, after buying a chain department store, be learning about the capex of the industry or how competition in the industry works or how inventory in the industry works, right? They did know enough. I'm not going to say it was totally outside the circle of competence. It's not like this was a semiconductor company, but they didn't really have the knowledge of how to run one of these, and that gets amplified the larger piece of the company you own. I would say to a lesser extent, it probably gets amplified like that when you get a board seat, right? If they just bought 12% of the company, got a seat on the board, it would be more of an issue than if they had a 2% share and had no say. So here are the details of the sale. So they ended up selling for $11 million after buying the company for $12 million. On top of that, they only got about $5 million cash on the day of the sale. They got some zero interest notes, so zero interest debt that they basically lent Supermarket General. And in 2 months, they would get paid for some of it, and then in 14 months, they would get paid for the rest of it. They had to pay back the bank on their original loan, and they said they were lucky to sell the business for about what they had paid in a 1989 shareholder letter, one that we'll be reading later on. So here's measuring the actual error itself. So while Hochschild-Kohn sat still, or it was actually losing money, about in line with the Dow, actually. The Dow lost money over these years, too. The Buffett Partnership, in the first year that they held this, gained 20%. In the second year, gained 36%. In the third year, gained 58.8%, and then in the fourth year gained 7%. So the cumulative gains compounding on each other was 178% is what the rest of the partnership did. Now, it's also worth mentioning that if they didn't have this big investment gaining 0%, that number might have been higher, but we'll just go with that number, right? So BPL compounded annual growth rate was 29% annually. Hochschild-Kohn's compounded annual growth rate was like -2 or -3% annually. So the total cost was about $9.3 million left on the table. So the total deal was $12 to $11 million. Their share was $4.8 million initially, and they exited with about $4 million. And what it could have been if they invested it was $4.8 million to, it would have been $13.3 million if it had just gained the rate everything else did. Their gain also would have been higher. They would have put that money into something else that probably wouldn't have lost money. And then if you want to look at this as kind of how much money would this be now? The total partnership pool at the dissolution was 104.4 million. If they had gotten the same gains on this money as they did the rest, it would have been 113.8 million. So they would have had 9% more money. And if we just go off of the current value of Berkshire Hathaway of 1.1 trillion, this money probably could have been an extra $100 billion today, maybe even a little more. So a massive mistake that early on. This was a lot of money. This was like 10% of their money that it was just stuck doing nothing for 4 years. Well, the rest of the money was gaining insane gains, 59% year over year gains here that it could have been doing. Total gain 178%. So a 2.8x is what the money could have been otherwise, maybe even a 3x. So yeah, an absolute blunder. But there was the gain of he got into business with Charlie Munger. It sounds like that would have happened anyway. It sounds like they were looking for an excuse to get into business together anyway. But that's like the one redeeming quality of this. You can maybe say that paid for itself, that ended up gaining them 9% somewhere along the way. Maybe it did. So Munger got his 2 happy days with the yacht, the day he bought it and the day he sold it. But the people who bought it off them, Supermarkets General, let's see how it went for them. They bought it in 1969. In 1971, they decided to go ahead and build that Columbia store that everyone was looking forward to in the company that everyone had their hearts set on. In 1977, they had to close down the main location. They were just left with the mall locations, the one in York and the Columbia one. In 1983, there was a building fire, and they just folded the division into the rest of their book. And then they ended up closing the chain and selling the locations to Hutzlers. So they did not have a fun time. It's not like Buffett just left early. This was unrecoverable, the people he sold it to. He talks a lot about how he tries to sell people good businesses at fair prices. He likes to buy good businesses at great prices, improve them, sell them at a great price, and feel like he left the buyer with something good that will make them money. In this one, he dumped a bag on them, and it didn't work out too well for them, and he just got out with what he could. So 20 years later, we get some retrospect on this. In his 1989 letter, he walks the shareholders through the trade, and we're actually going to pull that letter up and take a read through it ourselves. He talks about how he bought him at a steep discount to book value, and he just thought he couldn't miss. And probably back then with the performance he had been having, he just thought that everything, that it would work out. He could make anything work out. That he wasn't missing. He was doing insane numbers, the best numbers of his career at that time, partially because it was so small, partially because he was more aggressive, partially just because the market was less efficient back then and there was more money being left on the table for him to pick up. So before jumping into the letter, I wanted to read this quote from Charlie Munger from The Snowball. "We were enough influenced by the Graham ethos," says Munger, "that we thought if you just got enough assets for your dollars, somehow you can make it work out, and we didn't weigh heavily enough the intense competition between 4 different department stores in Baltimore at the time, when department stores no longer had an automatic edge." So that kind of plays into what I was saying, where they thought that just because they got enough assets for their dollar, that they got $2 for $1, that they would automatically profit. They all thought they were smart enough to make it work. And as that other quote mentioned, they overestimated how much their finance backgrounds would help in running a department store. So this is a reading from the 25th anniversary letter of Berkshire Hathaway, where he's going over the mistakes of his first 25 years. "If you buy a stock at a sufficiently low price, there will usually be some hiccups in the fortune of the business that give you a chance to unload at a decent profit, even though the long-term performance of the business may be terrible. I call this the cigar butt approach to investing. A cigar butt found on the street that has only one puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying businesses is foolish. First, the original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. Second, any initial advantage you secure will be quickly eroded by the low return that the business earns. For example, if you buy a business for $8 million that can be sold or liquidated for $10 million and promptly take lucky their course, you can realize a high return. But the investment will disappoint if the business is sold for $10 million in 10 years, and in the interim has annually earned and distributed only a few percent on cost. Time is the friend of the wonderful business and the enemy of the mediocre. You might think that this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Shortly after purchasing Berkshire, I acquired a Baltimore department store, Hochschild-Kohn, buying through a company called Diversified Retailing that later merged with Berkshire. I bought at a substantial discount from book value. The people were first class, and the deal included some extras, unrecorded real estate values, and a significant last-in, first-out inventory cushion. How could I miss? So, 3 years later, I was lucky to sell the business for about what I had paid. After ending our corporate marriage to Hochschild-Kohn, I had memories like those of the husband in the country song. My wife ran away with my best friend, and I still miss him a lot. I could give you other personal examples of bargain purchase folly, but I'm sure you get the picture. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie understood this early. I was a slow learner. But now when buying companies or common stock, we look for first-class businesses accompanied by first-class managements. That leads right into a related lesson. Good jockeys will do well on good horses, but not on broken-down nags. Both Berkshire Textile Business and Hochschild-Kohn had able and honest people running them. The same managers employed in a business with good economic characteristics would have achieved fine records, but they were never going to make any progress while running in quicksand. I've said many times that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I just wish I hadn't been so energetic in creating examples. My behavior has matched that admitted by Mae West. I was Snow White, but I drifted. So what can we learn from this? I think there's two halves to this, and I think the one that's most relevant is this: how to avoid value traps, right? Value traps fundamentally happen when you only look at quantitative factors, when you just look at numbers, when you just decide the business is cheap. But I believe, and part of what I preach, is that you have to take in all the qualitative factors, that quality is also part of value. You need to not just look at the on paper, how much earnings you get for your dollar, how much book you get for your dollar, all of that. You have to look at the industry itself. You have to look at the quality of the business. You have to look at the moat. You have to look at the growth, right? You have to look at all of these things. You have to look at the management and their incentives and all of this stuff. There are a lot of value traps I've avoided from this saga. I think this saga in particular has scared me off of retail. The Diversified Retail and Hochschild-Kohn and the lessons Charlie and Warren learned here are what kept me from investing in Lululemon or Nike, right? And I've been very happy to. And it's not saying that those are objectively bad or that the people invested in them will lose money, but I believe in taking a lot of pride in the swings that you don't take, that you don't have to swing at everything, and focusing on the swings you did not make that can be more important than the ones you did. And those ones are just in my too hard category, in the not for me category, in the out of my circle of competence category, in my not an amazing business with amazing fundamentals category. And then on top of that, I think this is something more for him. You'd have to be very rich for this to be an issue for you. Maybe one day, I hope for me, this is something that'll be important, but I don't think it really is for most of us. And that's that control investments carry a ton of extra emotional and societal costs that passive investing doesn't. And it makes it much harder to actually do what needs to be done if you are actually planning to buy up controlling stakes of businesses and unlock their capital. There's a reason that capital is locked up, and that's because the people in the organization are tied to it, or the local communities are tied to it, right? This is something he's going to run into a lot in his career, and I'm sure will come up where he ends up burning money to not hurt people's feelings. He ends up burning money to not be seen as a ruthless liquidator. He knows that what would be best would be to buy a company and shut down all its stores and plants or whatever, but he also knows Like with Berkshire Hathaway, if he shut down all its plants the day he bought it, he would make more money, but also he would like destroy the economies of entire towns. And I think that the most important thing that this investment has in Warren Buffett's like history is that this is one of those key pivotal moments, and he acknowledges it in the letter, that pushed him from cigar butt investing towards Charlie Munger's idea of buying great businesses at fair prices. And that's something that ended up having outsized returns. Actually, in the background of all this, when we look at the crazy gains, we look at that like 59% year over year gain. The reason Buffett Partnership the Buffett Partnership Limited tripled its money while he held this was because of the American Express investment, where during the salad oil scandal, American Express crashed. He bought up a ton of it. He deployed like 40% of the partnership's capital, and that was buying a great business at a great price. But that was one where it wasn't some distressed business or anything like that. It was just a great business. He bought it, and then he held it. And he didn't flip it, and then once it was fair, he just held on to it. He held on to it for a very, very long time. I think they might still be holding those shares, and it skyrocketed, and it made them all very wealthy. Meanwhile, this cigar boat was burning them. So thank you guys for watching. Subscribe for the next one. I'm very much thinking the next one's going to be Berkshire Hathaway, or at least I'm going to be working on that. It's possible that's a very big topic, that might be a bigger project, that might need to be multiple videos. I'm not sure how much I'm biting off. So I might do a smaller one on some small little story in between. If you guys like this, subscribe. These are definitely more of the kind of videos that I like and I want to set this channel apart with. Some of those other, like the tier list videos, they did great, but everyone does those, and I don't feel like I have as much to add as I feel like I have to add on a topic like this. This is like exactly the kind of video I would like to watch. Other things in the pipeline. So I'm going on vacation this weekend. So I recorded this in advance. I got to spend some more time editing. I hope you guys noticed that the editing was hopefully a little better on this. I'm trying to work on the editing. And anyway, I'm going on vacation. I'm going to have this prepared so I can release this while I'm on vacation and just make it public. But during my vacation, I'm going to finish reading The Outsiders. So hopefully I can get a video together on that soon. So I think that'll be interesting. But yeah, thank you guys. Appreciate it. Appreciate the love. These videos are doing they've just been doing better than I ever expected it would, faster than I ever expected it would. And I appreciate that. Please comment. I reply to every comment, and I appreciate every comment. Thank you guys. Have an awesome day.